Good afternoon, everyone. My name is Yolanda Vacha, the Program Director for today's proceedings. Firstly, I'd like to welcome the Governor, the Deputy Governor, members of the media, financial sector stakeholders, our online participants on Zoom and YouTube, and all the colleagues that are here today. A warm welcome to the first Financial Stability Forum of 2023. So today, we are launching the first edition of the Financial Stability Review for 2023. The FSR is released every 6 months and it reflects on conditions in the financial sector. This particular edition covers the period from December last year to date. It also identifies and assesses risks to the financial system in the coming 12 months. So this afternoon's proceedings will kick off with opening remarks from the Governor, and then Dr. Nicola Brink, the head of the Financial Stability Department, will then take us through the key points of the Financial Stability Review. At the end of the presentation, we will have a question and answer session with all our panel members that are on the stage as well as online, and there will be roving microphones for that particular Q&A session. Just in terms of some housekeeping rules for today, could I please request that everybody puts their phones on silent mode? I'd like to say shut them down, but silent is fine. And then members of the media that have joined online should please post their questions on the chat as we get closer to the time of the Q&A, and those will be relayed to the Governor during the Q&A session. A copy of the Financial Stability Review will be available upon the end of today's proceedings, so it will be as you exit outside the 2 back doors. There will be ladies that would be waiting for you with a copy of the FSR. So ladies and gentlemen, without further ado, I'll now hand over to the Governor for his opening remarks. Thank you.
Thank you very much, Yolanda. Good afternoon, ladies and gentlemen. I take this opportunity to welcome you to the first Financial Stability Forum of 2023. This forum takes place every 6 months and allows us to unpack how global and domestic developments affect the domestic financial sector and its ability to effectively perform its functions. The South African Reserve Bank's Financial Stability Review released today reflects on conditions in the financial sector. The department that produces this report, headed by Dr. Brink, is called the Financial Stability Department, and it has got a very simple task. They are paid to worry. They must worry about what could go wrong with the financial system and hope that nothing goes wrong. This time around, they did not have to look too far for reasons to be worried. Let me start with international developments since the release of the previous Financial Stability Review. The latest Global Financial Stability Report of the International Monetary Fund highlights an increase in financial stability risks as the global financial system has been tested by higher inflation and geopolitical fragmentation risks. Globally, systemic risk increased during the period under review due to further monetary policy tightening, persistently high inflation, and downward revisions of growth projections. Additionally, nervousness about the resilience of the global financial system, volatile financial markets, and most recently, concerns over the US debt ceiling have added to the risk outlook. Against the international backdrop of tighter and volatile international financial conditions, idiosyncratic factors in South Africa pose additional risks to the domestic financial stability and economic growth prospects. Last Thursday, we announced the MPC's unanimous decision to increase the repo rate by a further 50 basis points to 8.25, the highest level in 14 years. coupled with weak economic growth, limited job creation, and stagnant real incomes, developments continue to present a challenging operating environment for the financial sector. The most notable country-specific vulnerability, however, is the detrimental, widespread impact of an insufficient and unreliable electricity supply, combined with a deterioration of South Africa's rail and port infrastructure networks. Overall, systemic risk in South African financial system has increased and the outlook for financial stability has deteriorated. Since the release of the November 2022 FSR, 2 new risks have been added to the SARB's Risks and Vulnerabilities Matrix, the RVM, and those risks being capital outflows and declining market depth and liquidity, and possible secondary sections amid heightened geopolitical polarization. The prevalence of capital outflows, declining market depth, and lower liquidity in domestic financial markets is not limited to South Africa, and several emerging markets are faced with similar challenges. However, idiosyncratic domestic factors such as the risks to financial consolidation, the grey listing by the Financial Action Task Force, and electricity supply challenges exacerbate the risk. The FATF grey listing materialized in February 2023. Because expectations have been largely priced into the financial markets, the immediate reaction was relatively muted. However, the medium to longer term risk is that South Africa remains on the FATF grey list for an extended period, possibly longer than 24 months. The longer term impact of the FATF grey listing will depend on the speed and effectiveness with which South Africa can address the findings that led to the grey listing. Under the leadership of the National Treasury, various regulators and government agencies, including the law enforcement authorities, are working tirelessly to make sure that South Africa comes off the grey listing. Let me turn my focus to the mitigants against the risks identified. Despite an increasingly adverse operating environment, domestic regulated financial institutions remained resilient as measured by their ability to maintain adequate regulatory capital and liquidity buffers. These requirements have been designed and are calibrated to enable institutions to absorb and survive the impact of shocks. The South African financial system continued to function without interruption, and there were very limited spillovers from the global banking sector turmoil into our financial system. The SARB continued to collaborate with members of the Financial Sector Oversight Committee, a statutory forum that includes all the financial sector regulators and the National Treasury, to address some of the key risks to financial stability. The Financial Sector Laws Amendment Act number 23 of 2021 commencement schedule was published by the Minister of Finance on the 24th of March 2023. In terms of this schedule, the Corporation for Deposit Insurance, CODI, will only be fully operational from 1 April 2024. The SARB will become the resolution authority for designated institutions on the 1st of June 2023, on which date the resolution framework also becomes effective. The SARB, through the Financial Sector Contingency Forum, continued to plan for the unlikely but not impossible scenario of a national electricity grid failure. Let me repeat this. The SARB, through the Financial Sector Contingency Forum, continued to plan for the unlikely but not impossible scenario of a national electricity grid failure. In line with the role and function of the FSCF, current efforts are centered on developing, coordinating, and testing contingency plans to mitigate the impact of a national grid shutdown on the financial system and the economy. This edition of the FSR also includes an update on developments related to the establishment of a deposit insurance fund, an update on the implementation of the resolution framework, the implications should secondary sanctions be imposed on South Africa, and the failure of the Silicon Valley Bank in the US, and resulting scrutiny of different accounting treatments for banks' government bond holdings, both globally and domestically. As I hand over to Dr. Nicola Brink, the head of the Financial Stability Department, who will be presenting an overview of the FSR, I would like to close by reiterating the following. There are risks in the financial system, globally and domestic. We had taken measures to shock-proof the South African financial system. Our financial system has got capital and liquidity buffers that makes it resilient to absorb the shocks. That does not mean the shocks will not affect us. It just means that we are more resilient to be able to absorb those shocks. More details from Dr. Brink.
Thank you, Governor. Is this working? Thank you, and good afternoon to all our guests. Thank you for your interest in the Financial Stability Review, and for those of you who could make it in person, for making the effort to join us here at Waterfall Courtyard. I'm going to focus on the financial stability risks, vulnerabilities, and the outlook for at least the next 12 months, as we have it in the Financial Stability Review. This will lead me then to the overall assessment of financial stability conditions and some of the policy actions that were taken by the Reserve Bank, and I'll also highlight some of the briefings on selected topics that we've got in Chapter 3 of the publication. I include a definition of financial stability on this slide. It's the definition that we use in the Financial Stability Review, and it's rooted in the legal definition provided in the Financial Sector Regulation Act. The reason why I put it on the slide is to emphasize that we look at global and domestic economic and financial developments not for their own sake, but essentially to see if it would have an impact on the way that the financial system functions and if it would hamper any of the intermediation that takes place in the system. I'm centering my presentation around the Reserve Bank's risk and vulnerability matrix, and what you see here is the latest version that was approved by the Financial Stability Committee of the Reserve Bank a little while ago. The risks on the matrix are essentially the same. Some of them we've rephrased a little bit, but it's the same risk except for two, which are indicated there, the one on capital outflows and declining market, and also on secondary sanctions, the possibility or the risk of secondary sanctions against South Africa amid heightened geopolitical polarization. I'm going to talk about each of these risks in my subsequent slides, so it's not necessary to look at that now. I would like to, again, just explain how to interpret the RVM So on the horizontal axis, we indicate the time frame over which we expect risks to play out. So some risks will have an immediate impact if they materialize, while others have a slowly eroding effect on the financial system. In the Reserve Bank, we often refer to these different types of risks as either heart attacks or cancers. On the y-axis or the vertical axis, we give an assessment of how likely, firstly, we see these risks materializing, but also how likely it is that if it happens, that it will have an impact on the financial system, an adverse impact. The colors shows how serious we think the impact may be if the risk materializes. Important to note that we look at residual vulnerabilities, so we also take into account any mitigating factors, policies, or actions. And that, maybe just lastly, some caveat that we do a lot of analysis and research in the department, which forms the foundation of this assessment. But there's some judgment and subjectivity involved in assessing the likelihood, the term, and the impact. And that is why we color it not in fixed blocks, but in shades to show that it may be debatable, and it is often debated intensely in the bank. So moving to the first risk, higher interest rates for longer. Internationally, financial conditions have remained tight as major central banks continued their fight against persistent inflation. Both the speed and the extent of interest rate increases was unexpected, and indications are that rates will remain higher for longer than initially expected. In South Africa, the Monetary Policy Committee followed suit, including the most recent increase. The repo rate is now 475 basis points higher than in November 2021, and this was largely in line with international trends. So higher rates affect the financial system in various ways. It increases the cost of funding, both for institutions and for their customers. It erodes affordability of credit, and also the creditworthiness of customers of financial institutions. With higher rates, there's a risk of recession, and recession is expected in the major economies. And as advanced economies increase their rates relative to emerging markets, there's also a higher risk of capital outflows from emerging markets. In the US and Europe, the increase in interest rates and the recession fears have already contributed to some turmoil in their banking systems. Several regional banks in the US collapsed under funding and liquidity pressures, and undervaluations of long-term fixed interest rate assets on their balance sheets have become public knowledge. Confidence in small to medium-sized banks with similar exposures evaporated, and bank share prices declined sharply. The turmoil in the US triggered renewed concerns about Credit Suisse, a global systemically significant bank, to the extent that it resulted in a government-supported takeover by Switzerland's other big bank, UBS. There is an interplay between interest rates, credit extension, and non-performing loans, and this is closely monitored by the Financial Stability Committee. Bank credit extension has increased steadily from the lows recorded during COVID. Private sector credit growth, the orange line on the left-hand graph, is now slightly higher than nominal GDP growth. That's the dark blue line. Some of the reasons for this credit growth are a degree of distress borrowing by households as living cost rises, and significant spending on alternative energy sources. Combined with the impact of higher interest rates, it is not surprising that non-performing loans are also increasing. On average, the level of bank NPLs is at 4.7% of total loans and advances, but for certain categories of borrowing, particularly for unsecured credit, credit to small and medium businesses, and corporate credit, the ratios are much higher. Mortgages represent the largest part of banks' balance sheets, and therefore it is important to monitor developments in the property market. If property prices rise too quickly, it can contribute to overheated credit extension and asset price bubbles. If property prices decline, the value of banks' collateral can fall below mortgage values, thus increasing credit risk. The top graph shows that house prices, the dark blue line, continued to decline as inflationary pressures persisted and higher interest rates reduced affordability. Nominal growth in mortgage advances, the green line, remained almost unchanged at 7%. It is expected that higher interest rates will discourage home buying and continue to dampen house price growth. As borrowing cost increases, renting becomes relatively more attractive than buying, and that is shown in the bottom left graph. The blue line shows how vacancy rates have declined, while the orange shows how rental prices have increased. In the corporate real estate market, at the bottom left, the vacancy rate for office space in particular remained high at an average of 18.4%. The combined effects of higher interest rates, higher than inflation increases in property taxes, electricity, and other operating costs could affect affordability and viability and increase credit risk in this sector. Moving on from the topic of higher interest rates, an idiosyncratic domestic risk that has been on the RVM for several editions of the FSR is that of an insufficient and unreliable electricity supply. It is currently assessed to be the most severe immediate risk. At the time of the previous FSR, we highlighted the sharp increase of load shedding in 2022 from previous years. This year, it has become worse. In the year to the end of May 2023, about 13,000 gigawatt hours have been shed, compared with 11,700 for the whole of 2022. That's shown in the left-hand graph. The number of hours where South Africa had load shedding of some sort equates to 136 full days for the year to the end of May, meaning that there were only about 14 days in the year to date where there wasn't any load shedding somewhere in South Africa. The energy availability factor on the right has declined steadily. It averaged 52.8% in the year to date, and that compares to 58.1% for last year and just over 70% in 2019. The plant outages, that's the pinkish bars, have remained fairly constant. The decline in the EAF stems from unplanned outages, which have increased materially. Electricity supply and electricity interruptions affect the financial sector through multiple channels. Amongst others, it increases the cost of doing business, both for financial institutions and for their customers. It potentially lowers municipal and government revenue. It erodes investor confidence. It leads to unavailability of critical infrastructure necessary for the financial system to operate. And here we think about networks and data connectivity, with transactions increasingly becoming digital and electronic. This has a severe impact potentially on the availability of financial services. And then there is the lingering threat of a total grid failure, which is unlikely because load shedding is actually intended to prevent this. But it will nevertheless have severe consequences should it happen, and thus the preparation that is currently being done. The financial sector's high exposure to the government, combined with a high level of government debt and a credit rating below investment grade, makes the financial system vulnerable to a sharp repricing in government debt. A mitigating factor is that this exposure is more concentrated in small institutions. The large, systemically important institutions have more diversified balance sheets. There are some risks to fiscal consolidation, which stem from the weak economic outlook, pressure from the public wage bill, committed spending items, and high levels of SOE debt. The concentration of investment in government bonds increases financial market volatility and leaves less savings to be channeled into private sector investment. Accounting practices allow financial institutions to record their holdings of government debt that are not actively traded at amortized cost. This may result in valuation losses in a rising interest rate environment. This is a risk that has been discussed by the Financial Stability Committee and that is closely monitored by the Prudential Authority. The left-hand graph here shows how non-SIFI banks in particular increased their holdings of government bonds over recent years. Obviously attracted by high nominal yields that offer an alternative source of income in an environment of lackluster growth. The right-hand graph shows that accumulation of government bonds by non-bank financial institutions is also strong. Combinedly, NBFIs took up more than 95% of the 73-odd billion of bonds issued since the previous FSR. South Africa's grey listing by the Financial Action Task Force has materialized in February. The initial impact had been priced in before the actual grey listing, so the impact of the actual event was fairly muted. The reason why we keep it on the RVM is that we think that the longer we stay on the grey list, the more lasting and the more severe the effects will be. So the next assessment by the FATF is in 2 years' time. If we manage to get off the list by then and address all the findings, the impact will probably be much less severe. So what are the effects? It's the same things that we mentioned in November: higher transaction cost, more scrutiny for South Africa's financial payments and international payments and international participation by our financial institutions, generally an even higher country risk premium, which will increase the cost of funding in international markets even further, continued reputational damage and capital outflows, and there are also regional spillovers, as South Africa is in many respects the link of some of our neighboring countries to international markets. The left-hand graph shows that the FATF grey listing contributed to rand weakness well before it actually happened. In stark contrast with the currencies of other emerging markets, the rand depreciated by 8% since the previous FSR, while the basket of emerging market currencies appreciated by 3.5%. This underperformance of the rand was not only as a result of the grey listing. Other contributing factors included load shedding and the weak economic growth that follows, geopolitical risks, and which contributed to large capital outflows. By the time the grey listing happened, it had largely been priced into the yield curve. The steepening of the yield curve subsequently, and since the last FSR, also reflects investor concerns about fiscal risks and net redemptions of around 1.7 trillion over the next 7 years. This is a new risk on our RVM. The risk of potential secondary sanctions to be imposed on South Africa amid heightened geopolitical polarization. So what we mean by secondary sanctions, there are primary sanctions against Russia itself, but any country that is assessed to assist Russia in its war efforts can also be subject to sanctions by the US and other Western countries. Now, South Africa has a neutral stance, but this political neutrality is increasingly being questioned in media domestically as well as internationally. Our membership of BRICS and the bilateral political engagements add to the complexity of maintaining a convincing neutral stance. It's early days and we cannot predict whether anything will happen in this space and how it will look. It can take any form and may not be as severe. One issue that is a reality is that the mere anticipation of possible sanctions already affects risk appetite for exposures to South Africa. If an actual event happens, depending on the nature and the extent thereof, it could have the following effects. It could restrict South Africa's ability to make payments in US dollars, which will affect our trading payments and investment flows. There will be a further loss of correspondent banking relationships, damage to relations with our main trading partners, and possible loss of preferential trade agreements. There could even be a sudden stop to capital flows, and this will also have a severe regional impact because our neighbours depend on the South African financial markets to affect their international payments to a large extent. This is a long-standing risk that is eroding the foundation on which the financial system operates. It interacts with most of the other risks and vulnerabilities, so there is some overlap in the channels and effects. So far, financial institutions in aggregate have managed to remain profitable and also to meet their regulatory requirements. However, over the longer term, this resilience may come at the cost of increased risk-taking to protect profit margins or reduced profit offerings to cut costs. One example of reduced product offerings that we observe is the increasing number of uninsurable risks that occur so regularly now that they are becoming systemic. Another new risk that we added to the RVM is that of capital outflows and declining market depth and liquidity. Deep, liquid and diversified markets is a source of resilience in the financial system. It enhances accurate pricing of financial products, it lowers financing costs, and it provides a source of liquidity to financial institutions, even in adverse market conditions. Conversely, a loss of liquidity and financial markets that are increasingly dominated by a few buyers and sellers with similar strategies is a source of vulnerability. Such markets are more prone to volatility and periods of dysfunction. They result in more expensive financing and they reduce the ability of financial institutions to raise liquidity in stressed scenarios. This graph is not in the FSR, but I've included it because it illustrates how financial market liquidity has trended downwards over the past decade. The lines show turnover in the secondary market as a percentage of total market capitalization for both equities and bonds. We can see that in the bond market, the trend is more pronounced because foreign investors, who typically provides more liquidity, have significantly reduced their holdings of government bonds. Domestic investors who picked up this slack have proportionately more buy and hold strategies. The reasons and implications of lower market depth and liquidity and the interplay with capital outflows is one of the topics for further research on the SARB agenda. This is an existing risk, and we have written extensively about the direct and indirect impact thereof on the financial system. There isn't much new to add, except perhaps mentioning the strong drive in South Africa towards alternatively energy sources. While this is good for the environment, it will have long-term benefits for the economy. It will also erode the income of Eskom and municipalities in the interim period, which may have negative spillover effects. The last perpetual risk is that of a successful cyber attack with systemic proportions. The growing dependency on IT for transactions and communication, increased reliance on third-party service providers, increased centralization of key IT infrastructure, and the reliance on global financial market infrastructures over which we have little control increases South Africa, the financial system exposure to this risk. A mitigating factor in our domestic market is the significant spending on IT security. However, smaller financial institutions remain relatively more exposed, but at least they've got a lesser systemic impact. This brings me then to the overall assessment of stability conditions. Overall, systemic risk has increased since the previous FSR against an adverse global backdrop. Idiosyncratic domestic factors that I'm not going to repeat here continue to weigh on domestic financial sector resilience. In aggregate, prudentially regulated institutions remained resilient and met their regulatory requirements, and we also assess the overall financial system to be resilient. But we do want to note that even slower and more inequitable growth, combined with the idiosyncratic factors mentioned in the FSR, will test resilience beyond the forecast period. Some of the policy actions that were taken by the Reserve Bank based on its legal mandate and available powers were the following. There was continued collaboration with members of the Financial Sector Oversight Committee, FSOC. So the FSOC is a statutory committee that comprises mostly the financial sector regulators, and some of the risks, notably the impact of load shedding and the possibility of secondary sanctions, had been discussed extensively. Financial stability is a shared mandate in a way, and some of the actions are within the power of FSOC members. The Financial Stability Committee retained the countercyclical capital buffer at 0%, where it had been for a couple of years, but resolved to determine a future positive neutral level. So we don't regard 0 as a neutral level, because the idea is that the buffer should be released when conditions become more stressed. That means that it has to be at least above 0. With the implementation schedule for deposit insurance and the resolution framework published. There is the implementation of both these frameworks continued, as did planning for the unlikely but possible scenario of a grid shutdown. And then lastly, the Financial Stability Committee also gave consideration to whether the bank's sovereign nexus requires policy intervention, but this is ongoing work. To conclude, we cover 5 topics in Chapter 3. We provide more detail on the financial stability implications of an insufficient and unreliable electricity supply. There's an update on progress with the establishment of the Corporation for Deposit Insurance, or CODI. There's also an update on progress with the implementation of the resolution framework. We have a write-up on the risk of secondary sanctions and specifically what it will mean for financial stability and the economy, if it should happen. And then there's also a focus on the failure of Silicon Valley Bank in the US, and specifically how accounting treatments contributed to the failure. With that, I conclude my presentation. I think it would just be fitting for me to also acknowledge all the work done by the Financial Stability Department during the 6 months past and thank them for their efforts. With that, Governor, I hand back to you.
Thank you very much, Nicola. She's not the only one who is paid to worry. There is a whole army of people whose job it is to worry, and they are here amongst us. At this stage, we'd like to turn over for questions that you have. Any comments that you have? You can also give compliments. They are also welcome. And for those who are online, the FSR will be posted on the website together with the presentation. Will be posted on the website. So don't feel disadvantaged that you avoided the mid-rand traffic and now you do not have the information. Good. This normally happens. Everything is clear as mud. And okay, those online. Anybody online?
Yes, Governor, but we don't have questions yet.
I know. I mean, well, we also have people in the room and we don't have questions yet.
Thank you. Okay, I hope it's working. Thank you. Thank you, Governor. Thank you, the team and Nicola. Thank you for that. I am from KPMG. I have 2 questions. The first question, Governor, is about the repo rate. You mentioned that the repo rate has been growing on par with the rest of the world, I think 4.25% since 2021, if I understand well. My first question is basically, are we looking to stay online with the rest of the world in that growth, or is there a divergence somewhere, and what will be the impact on the currency and the economy? My second question is on the on SVB, Silicon Valley Bank. I think their understanding here is that accounting treatment is one of the drivers of that failure of underestimating the risk of the bonds in the balance sheet. Is there a risk that a Silicon Valley Bank failure type could happen in SA? And also, what measure are being taken to ensure that that could not happen? Thank you.
One more? Or two more. Mamma mia. Okay. You said you are from KPMG, but you do have an identity. I didn't get your name.
Oh, sorry. I'm Auguste Claude, so I'm a partner
Okay, thank you very much. You talked about the repo rate. In the commentary, people had tended to forget that actually the US raised rates more aggressively than us. We might have started early and had raised it more often. But as of before we got into the last meeting, they had raised rates more aggressively than us. Understandably, they came from a low base. But when we started, we were moving in baby steps, 25 basis points, 25 basis points. But as the risks escalated, we increased the pace at which we adjust the repo rate. Were we doing this to stay in line with the rest of the world? No, we were not doing it to stay in line with the rest of the world. We were doing it because we were faced with a particular inflation challenge in South Africa that we had to deal with. And many emerging market central banks that started to tighten monetary policy were facing similar, if not even more challenging inflation situations. You must grant it to the Latin American central bank governors. They can see inflation from a distance, and they started acting as early as May. We only started acting in November. By the time we acted in November, the Latin American central banks had moved significantly, and the reason is not hard to find. The memories in the Latin American public of hyperinflation still lingers. And it is important for us as a country to make sure that we never even think that we will end up with hyperinflation. And so we have got to cap it earlier. It's important to cap inflation earlier for the purposes of today because it has got implications for financial stability as well. But more importantly, is what inflation does to the incomes of working people. You are a partner, maybe you guys as partners, you might meet and decide on an additional increase for yourself, but you will find it very difficult to socialize it in the organization because everybody else in the organization, as it happens in other organizations, you can only adjust your salary once a year. And you go and you get your salary, you negotiate for your salary to be adjusted on the basis that this is what I expect inflation to be. Should the central bank fail to control inflation, or should they be shocked by an event that impacts adversely on inflation, and inflation comes out higher than your salary increase, you are left out of pocket. And so it is important that we curb inflation. But even more worrying in South Africa is that if you take the South African income earners and you break them into deciles, brackets of up to 10 brackets of all the income earners, you'll find that inflation at the lower decile, inflation of the low income earners is at its highest. It's higher than the inflation of those who are earning even a better income. Couple that with the fact that the people with lower income spend a disproportionate amount of their money on food and transport. Logically, a government that cares about the poor has got to worry about inflation and what it does to the poor. At least there is a central bank in this country, and the central bank does care about the poor. And we feel duty bound to cap inflation because of what inflation does to the living standards of the poor. Many of us here would have some form of property, maybe some form of investments. When inflation goes up, your property values might go up, and so you have got some form of a hedge. And if you have a little bit of cash on the side, You might identify financial assets that will protect you against rising inflation. But if you are in those low income brackets, that is not an option that you have. And so let's get this clear. Inflation is an enemy of working people, particularly those who are earning less than what the majority, some of us are earning. It gets eroded in that manner. And then so you ask the question, we're staying in line with the others, what would be the impact on the currency? The impact on the currency is a complex matter. It has to do with more than interest rates, particularly even not much with short-term interest rates. I know that the markets will react when we adjust the policy rate, but it's normally short-lived because the concentration span of a foreign exchange dealer, you are very lucky if it goes beyond 3 days, okay? And so their reaction to changes in the policy rate, they will react. At that time, they got it wrong, and they just change their position and they take a new position. What matters is the impact of our policy stance on capital flows. And capital flows are not driven so much by the policy rate, but are driven by the long-term bond yields. Most of the time, looking at the 10-year bond yields. And there is a very strong correlation between the US 10-year treasury yield and the South African 10-year treasury yield. Yes, there is a gap. South Africa pays more than the US. But the point of departure, if you are an investor, to look at which bond between the two, US or South Africa, to buy, your point of departure is, what is the inflation rate in South Africa today, and what is the inflation rate in the US today? What is the inflation rate in South Africa likely to be in the future, and what is the inflation rate likely to be in the future in the US? And so, anyone who thinks that you can allow inflation to run a little bit higher and maybe we will get a little bit more growth is actually also saying the government must pay a little bit more on its borrowing rate, because no one will lend money to the government at a rate that is below the inflation rate. And then, of course, as we were talking, there is another little complicating factor that as an emerging market country, we are not the benchmark. We are priced off the benchmark. The benchmark, in this case, take it as the US, because that is the most liquid of the bond markets. And so somebody is going to then say that if I am to buy South African government bonds, I need to be compensated. I want a spread. I can't eat this slice of bread dry. You must add a little bit of spread, butter or whatever, jam, whatever it is. And depending on what I view, I might ask that the spread be thicker than it would have otherwise had been. And of course, these clever people complicate it. They call it the country risk premium. Okay? And that spread that is demanded by the investors, in the case of South Africa, it has risen as a result of those idiosyncratic risks that we have identified. Everything from load shedding to the stance that we take internationally to, apparently somebody said something about us and what we do with some other country and some other equipment, and then that complicates our life, because then there is uncertainty. As we stated, if that is the case, or if an average investor suspects it might be the case, the average investor would say, wait, I would like to be compensated, or wait, I am not going in there until that uncertainty has been cleared. And that is the price we pay with these idiosyncrasies. I took longer than I normally do on this because I noticed nobody was interested in what we were saying. SVB and the accounting treatment, I know it's not that we want to blame the accountants on this one. It actually, it is an accounting treatment, but the accountants were just fine. There is a standard on how you treat these things. You must mark them to market and so forth and so forth. And there is a choice that you could make and say that, no, but this bond I am holding to maturity, and because I am holding it to maturity, I do not have to mark it to market. Except that suddenly you need the cash. And once you need the cash, you can't hold it to maturity, and then you must liquidate it for the cash. And by that time, the price has changed, and now you must take the knock on your income statement and on your balance sheet. That is what we had seen. In the case that you've talked about, could that happen in South Africa? The Prudential Authority has been pretty activist. And should the Prudential Authority, for some reason, not be very active, the auditors are not so kind to people who pretend to hold things to maturity, which they might need, and the auditors might just say that it must be repriced. So the practices in South Africa are different, but we are watching these things with very closely. That does not mean it could not happen. All that we are saying is that the likelihood of it happening in South Africa is actually much lower because we had been watching.
Can I add to that?
Yes, please.
Thanks, Chair. So just quickly on Silicon Valley Bank, right? So there are 2 or 3 similarities between that and South African banks, and some of them, small banks in particular. Nicola showed the graph of how much small banks hold. So small banks do own a lot of government bonds, and these are fixed income instruments. They hold to maturity basis, so they, we're going to keep them. We don't mark to market. But as the governor said, if you have to sell because you need the cash, then you do have to market, then you get an impact on your balance sheet, right? So that's what some small banks have in common with SVB. But there's some differences as well. The first is that Silicon Valley Bank had a highly concentrated deposit book. There were about 30 or 40,000 very large investors that held a really large amount of money that was way above the insurance deposit limit. Most South African banks have got quite a diversified pool of small depositors. The second is that in South Africa, we have fully implemented Basel III for all of our banks. And part of Basel III is this thing that Jason will call draconian, called interest rate in the banking book. Right? So we forced the banks to do a stress test on interest rate risk in the banking book and to hold more capital against any potential changes to interest rates. In the US, a bank like Silicon Valley Bank did not have to do interest rate risk in a banking book. Only the top 17 or 18 banks actually fully complied with Basel III. So that is a significant difference between South African banks and what happened in the US.
Thank you, Governor, and Dr. Brink, for the very insightful presentation. My name is Ewald Kellerman from ABSA. I've just got 2 quick questions. The first one, with regards to Dr. Brink's presentation around the counter-cyclical credit buffer. You mentioned that it's not at a neutral position yet. Would you mind expanding a little bit of what a neutral position is and under which conditions that might change? It might give us a sense of where we sit in the cycle. And I think the second question is, aside from monetary policy responses, what can either government and or private sector do to help relieve some of the consumer stress? Similar to the actions that we saw under COVID, if there's any mechanisms that we can employ to help relieve consumer stress. Thank you.
We have people online. Now they are interested.
Now they're very interested, Governor.
Okay, but let's take that one and then we will go online.
Thank you, Governor. Thank you, Dr. Brink. I'll be fairly brief. Switzerland had to take very extraordinary measures in their market. we've got this instrument called additional tier 1 in the bank's capital stack that obviously had to be written off. Governor, would you mind sharing your thoughts around a similar application in South Africa? You know, I think investors, you know, would like to see that that asset class is senior to shareholder equity. But I think the way it played out in Switzerland is fundamentally different. I think, appreciate if you can provide some color on that point. Thank you.
Okay.
Governor, the questions that we have are from YouTube. The first question is, we see the proposal is for Cody to cover up to 100,000 Rand. How did we come to this figure, and shouldn't it be higher? The second question, what could be the impact if the grid collapse? Would we still be able to transact? The last question, we are hearing the South African Reserve Bank increasingly speaking of idiosyncratic factors contributing to inflation, and also now the risk of financial instability. Is the bank engaging with government? Those are all the questions for now. Thank you, Governor.
Okay. Dr. Brink, there is no free lunch. You invited that one, so they will talk to you about the counter-cyclical capital buffer. But I'm going to attempt to answer the caucus and see if I understand them, and then you will go and mop after me if I got them wrong. The one question I'd want to deal with is, what can the government and the private sector do to help cushion the consumers? If you ask this gentleman here from KPMG about the advice, he will give you a schedule of billing hours because the advice does not come for free. And I know one thing as a regulator. I know how to formulate regulations and enforce them. So if you ask me for business advice, you've come to the wrong place. I'm not going to be able to help you. But the steps that the private sector took in 2020 were facilitated also by a relaxation of regulation, because we actually were faced an extraordinary shock that comes once in a century, or that's at least what had been seen before. I would hasten to argue that is not what we face now. And what we face now and the things that must be done are things that governments and businesses do when they are faced with circumstances of this nature. So, our country risk premium goes up. We have got to ask ourselves, why has the country risk premium gone up? What policies should we be taking? The key driver of the country risk premium is the fiscal stance. I am not going to say what the fiscals must do. It's just summed up in one word: just be prudent in the implementation of fiscal policy. What that prudence actually is, that's not for the central bank to decide. It's for the government to decide what that prudence is. We have got a problem with electricity and load shedding. And let me underline this. We don't have an ESCOM problem. We have got an electricity problem. We need it. So, what needed to happen is to say, who can generate the electricity? Bring it on. And in a way, the government's reforms in the electricity sector was meant to deal with that. So there are a number of steps that government does. So I can only highlight what government has done. I cannot provide advice to government on what it should do. And the reason is very simple. They also do not provide me with advice, and I would like to keep it that way. So I do not advise government, then they should not advise the central bank as well. So we will keep it that way. The stuff on the caucus. The caucus came as a result of the post-2008 global financial regulatory reforms. And it was meant that these things will help to absorb the losses in the case of a crisis. And the thing about Regulation 101 is that once you said this is what you will do if a crisis comes, that is what you must do. What we had seen in Switzerland was changing those terms and putting equity holders ahead of the people holding those instruments, which was not quite in the order in which we were thinking about dealing with loss absorbency. That actually led to the euro area having to publicly announce that no, they will stick to the rules, and a number of jurisdictions said that, but the damage was sort of like done because there started to be question marks which other regulator could actually do this, and that had created uncertainty in the issuance market of the caucus, and it might have actually even affected the secondary market. But Nicola would deal with that as a supplementary examination. Cody, why stop at 100,000? Why not make it higher? I didn't know we have got people with that amount of money in South Africa in the bank. But at 100,000 rands, we are covering 97% of all the depositors by account, not volume, by account. 97%. So trying to increase that, we are just trying to deal with the 3%, which means it's people with lots of money who should know better, by the way. Right? The deposit insurance is to try and protect the vulnerable. And where we have this threshold, we are covering 97% of the accounts in the South African banking system. And as far as we are concerned, that would be adequate. And internationally, there are comparables. If you are interested, you can ask Dr. Brink to do another supplementary exam. If the grips collapse, can we transact? Apart from the Department of Worries, the one chap who really worries about the grid is that one. It's DG Naidu. So he chairs the Financial Sector Contingency Forum. And they do all sorts of things. They simulate things. What if, what that, what this, what that, and so forth. So he will give you chapter and verse of that and what must be done. Why don't you deal with that whilst I try to recall what the last question is?
Sure. The Financial Sector Regulation Act has something called the Financial Sector Contingency Forum. It was actually put in law recently, but it was started when Tito Mboweni was the governor. And it was put in place after...
They say your response is actually very important. You must come to the podium.
Hi, can people hear me? Good. So Governor Tito Mboweni put this thing in place called the Financial Sector Contingency Forum. It's chaired by the SARB, it's chaired by the Deputy Governor responsible for financial stability, and it involves major role players in the financial sector to plan for contingencies. And in the last 10 years, we've done a simulation on a terrorist attack. on a bank headquarters. We've done a simulation on cyber attacks. And much more recently, we've been doing simulation work on a complete grid collapse. Right? And we've been looking at how we can build a bit more resilience, how we can prepare for this. Now, there's a narrow part of the work and a broader part of the work. The narrow part of the work is that the governor of the Reserve Bank has got the power to close markets in an emergency. Right? It's almost like a war provision. It's called the opening and orderly closing of markets. The closing and orderly reopening of markets. And what we've done in the last few months is to essentially put a playbook together. So if there is a grid shutdown, how do we orderly close the markets? How do we square the market so that nobody loses out? How do we ensure a level playing field that if you're an investor in Toekomsrus or in Toulouse, you've got the same access to the South African market, all of those kinds of things. And we've put, working with the JSE, with Straight, we've put the steps, the playbook in play, right? That if we were to be a grid shutdown, this is what we could do. But we've also got a couple of other projects underway in terms of the financial sector contingency forum to see, would it be possible to distribute some cash for a couple of weeks? Maybe, maybe not. ATMs use electricity, but in some shopping malls, they've got generators. Would we be able to run part of the payment system for a few hours a day just to try and prevent panic and allow people access to certain retailers? All of that work is ongoing, and we're working quite closely with the telecom sector, with the diesel suppliers, with the banks, with the payments industry, with retailers, to try and ensure that we can gradually raise the resilience of the financial sector. This is still very early work, still very preliminary work. There's no detailed plan yet, there's no detailed blueprint yet. But what I can say is that if you have to ask me a month ago, I would have probably said that in a complete grid shutdown, there'll be almost no transactions. I think that just technology and planning, saying that if there were to be a complete grid shutdown, we may be able to run some transactions. Right? We may be able to have some functionality in the payment system, even if it's for a short period. I don't know how resilient that will be. A network is as strong as its weakest link. But I can assure you that the financial sector is doing work on this to try and prevent chaos, prevent panic, and enhance their resilience. Thank you very much. There was a question on idiosyncrasies, South African idiosyncrasies, and are we speaking to government? Let me just first be clear what we mean by idiosyncrasies. So if you take the Ukraine war and its impact on oil prices, on Ukraine-Russian war and impact on fertilizer, that's not a South African you know what I mean, syncrasies. Okay, no. So we're all equally affected. If the U.S. is tightening its monetary policy, and it has implications for many of us, many emerging markets are affected. So I think what we're referring to is very specific things. And these specific things have to be also contextualized. So you may say that we're worried about our infrastructural capacity. The big concern at the moment is how do you get goods to the ports. Now, you may say that South Africa has a very sophisticated infrastructural capacity relative to many of our colleagues in the African continent. But I think that the concern about South African specific issues is how this is deteriorating over a period of time. So those are the kind of, so this, this confluence of issues, the FATF, the load shedding, the governor has, it was timed, we planned it that way. The governor had raised this issue of the risk premium, and it's quite an important thing to bear in mind. If you look at the Financial Stability Report, South African total debt, public debt as a percent of GDP, in around 2016 was 40%. It's now hovering between 70 and 80%. And where South Africa is unique is that very few countries have seen such a high pace a rapid pace of growth in public debt. So the rate of growth of our public debt has been unusual. So all those contribute to South African specificities. The question you ask is, are we speaking to government? Firstly, I should say that the SARB often engages government, not exclusively, but primarily through Treasury. We have very close relation with Treasury. Treasury obviously is the vehicle through which it engages a cabinet and a number of players. But I think our role really is to kind of identify all the constraints to growth. We have a role to work around the constraints and make sure that we can bring inflation down, taking growth and inflation trade-offs. So, central bank is, when electricity prices go up or municipal taxes, we play a very important role in engaging regulators. But I think that, many people in government recognize the problems. Some of these are problems that cannot be solved today, but it requires resolve. The best we can do is give you an analysis of where we are at and what role the central bank can play within its limited domain. Thank you.
So, Governor, I'll give you a solid pass. Just to add a couple of things on the counter-cyclical capital buffer. So the counter-cyclical capital buffer was part of the Basel III reforms, and its purpose is really to require banks to build up some additional capital in good times so that these can be used in bad times. So it's supposed to act counter-cyclically and absorb some of the shocks that may come around, almost like we did in the COVID period. Now, in South Africa, the counter-cyclical capital buffer has been at 0% for as long as I can remember, basically since introduction new. So that makes it totally ineffective as a counter-cyclical instrument. This is, in principle, the Financial Stability Committee has decided that the neutral level should be positive, so above 0. That would allow us to increase and decrease it. The range within which we can work is between 0 and 2.5%, so we're not talking about a 10% buffer. Work is currently underway to see what the neutral level would be. So it would most likely not be at the high end, but it can't be at the low end, so somewhere in the middle. That's not the only decision. The other decision is where should it lie within the capital stack. So should it lie within the core elements or within the buffer elements? It's got different implications. It's also still to be decided, should it be an increase in capital requirements in absolute terms, or should it be funded by reducing one of the other layers in the stack? That work is ongoing. I'm not able to say now. All I can say is that how these things work is that we'll do an impact assessment. We work closely with the Prudential Authority. There will be consultation with the banking sector, and there will be a phase-in period. That's part and parcel of the design of the framework. On the AT1 and T2 instruments, what we had with Credit Suisse was a contractual bail-in, so investors actually got what they agreed to contractually. It wasn't as if they should have been surprised, but they were. And I think the reason they were is because the communication during the resolution planning process was a bit different. So AT1 instruments is part of the regulatory framework, and they are bailed in or written off or converted to equity depending on the contract outside of resolution. And I think that's the big difference. Inside resolution, so once a resolution has been declared, it is 100% certain, it's it's fixed in law that we have to follow the credit hierarchy, and that is also what the European and other resolution authorities confirmed directly after the Credit Suisse event. The reason why the Swiss didn't put Credit Suisse in resolution and why they had to act on the AT1 contracts were peculiar to their legal framework and certain constraints that they face and which they are working on now. So in South Africa, we also have the two systems. We've got the point of non-viability at which the regulator has the power to bail in contractual instruments. And then as from Thursday, we'll have the statutory bail-in powers in resolution. If we trigger resolution, there's no doubt we'll follow the credit hierarchy and 81 instruments will be subordinated to equity. We've got one advantage over the Swiss situation, well, actually a couple. We don't have the legal constraints. The intention, and this we put out in the discussion paper we published in 2019, so the intention is definitely to follow the credit hierarchy. Bail-in would only be applied to our big banks. We won't require the small banks to have statutory loss-absorbing capacity for resolution. With the PA and the resolution authority located in one institution, I personally cannot foresee a situation where the PA would bail in statutory or contractual instruments without consulting in the broader bank. And if it's a SIFI, the chances are anyway that it will require a resolution. So therefore we can with sufficient certainty say that we cannot foresee a situation where it will actually be necessary to bail in 81. And I think the Swiss wouldn't have preferred to do it either if they didn't face those technical constraints. On the deposit insurance, the governor is right about the number of accounts fully covered. Obviously, the percentage not covered constitute corporate deposits. The deposits by the financial sector is excluded anyway, but large corporates for which it wouldn't make a lot of difference whether you cover 50, 100 or 200,000. The higher the coverage, the larger the cost on the consumer, on the banks firstly, and we expect that they may pass on some of the cost. Currently it's quite affordable and we achieve what we wanted. We did not pull the 100,000 out of a hat. We did 2 surveys of deposits in all the banks and cooperative banks and mutual banks. And it's based on that we were able to say it protects the most vulnerable ordinary depositors sufficiently. And we don't want it to be too expensive to protect the few large depositors. It's not, it can obviously, as the circumstances change, it can be adapted from time to time, but I think for the foreseeable future we don't see a need to increase it significantly. Thanks.
Okay, are there still questions in the room? I'm taking the last round. I'm sorry, I must apologize for DG Fundi. She is across the Atlantic. She is listening, and unfortunately there have been no questions that could be sent to her.
Good afternoon, Governor. The name's Peter Hill. One of your stress tests was on a sell-off on government bonds. Would you like to give us some sort of information on the scale that you would look at of a sell-off compared with what we're suffering at the present time? That's my question. Thanks.
Okay. Hi, my name is Leandra. I work for Nedbank. So my question is whether there's any concern regarding the stress on the consumer and whether that's a financial stability concern at the moment, considering that interest rates have increased by 475 basis points since November 2021. Cool.
That's the last one, right?
Evening, everyone. I just wanted to ask, what's the likelihood for us going into a technical recession, given that the Minister of Finance has also indicated that growth needs to be revised, and in the NPR earlier this year, growth was revised, citing there's a possible revision of growth, citing load shedding being a concern. And another fear right now is the fact that our target for revenue might see a deficit of 60 billion. Thank you.
Okay, good. Rashad, can you deal with the steer on the market dysfunction and the lot? Actually, whilst you are at it, you could as well just deal with the stress on the consumer, and then I will deal with the likelihood of a recession.
Yeah, I'm just going to, let me come up.
Yeah, I want you to come here. Matati says she can't hear you.
Yeah. Let me just say that I'll speak generally about market dysfunction. I'll ask Nicola to come in on the specifics of the stress test. Just to say that something that always bothers us is what happens. What we use the technical term sudden stop. What happens if capital stops flowing into this country? We have a current account deficit, and how do we fund that? So that's linked partly to the test around understanding what will happen to yield. So, for example, when non-residents increase their yields from something like 15% during the 2008 period, and that went up to 40%, that compressed yields. Now, as you rightly say, we are kind of experiencing the opposite, that not only the risk premium, but as foreigners pull out their yields, their bonds out of South Africa, that has an effect of increasing yields as there's kind of now less demand for our bonds. So interest rate risk is something that actually we're quite familiar with in a country like South Africa, and in a country like the US took many people by surprise because they're not used to, have always been operating at the zero lower bound. In this country, banks often have to deal with interest rate risks. And I think, without being too complacent, Nicola will fill you in, is I think that our stress tests were more realistic because we deal with it on a daily basis. Although Kuben did point out that what was unique about SVB, because many other banks in the US had interest rate risk, but SVB had a very narrow deposit base. So market dysfunction, it is something that the report talks about, that we are not there to intervene in the market for the sake of it. We are market maker of last resort. What we did in the COVID period is we found that in the bond market there was evidence of market making being impaired. So if we are in that kind of situation, we throw liquidity into that area. That has the consequence of reducing the yield and making the cost of borrowing lower for a short period of time. But that's an added consequence. Our main part is to get liquidity in the market. But I'll ask Nicola to come in. The issue of the consumer is when we increase interest rates, it is painful to do that. We're acutely aware of people. If you had a R1 million bond and you're looking at a 475 basis points, you're now paying close to 5,000 Rand more on your asset. But at the end of the day, what we are trying to do is we may slow down economic activity now in a small kind of way. But what we know is that slowing down economic activity now means that we don't have to do massive slowdown of the economy when inflation goes totally out of control. So that is the logic. You know, the logic is everyone says, why are you tightening when real disposable income is forecast to only grow by about 0.5% this year? Why on earth are you tightening? And I think that an important part of the monetary policy thinking is that some tightening now, some little slowdown, kind of a marginal slowdown of the economy will secure you from slowing down the economy by 500-600 basis points when inflation goes totally out of control. So just to say that, you know, we look at all sorts of figures about, the governor talked about inflation by decile. We know that the household is stressed, but that's a bigger problem that we can't address within our limited tool. Thank you.
So I am going to follow the governor's example. I'm going to answer the stress testing question, but I'm going to ask Bafa if I have anything wrong or leave out important information to add to my response. We did not do a specific stress test on a sharp repricing of government debt. So when we do the normal common scenario stress tests, it is typically a very adverse environment with macroeconomic variables that move in a certain direction. The scenario is developed in consultation with our economic research departments and the modeling team, so that it's plausible but very severe. Part of that scenario includes a sharp, an increase in bond yields. So that is not per se testing the resilience against that. What we did do internally was to do sensitivity analysis, so not a fully fledged stress test, but sensitivity analysis against an increase in yields. And we looked at it from both sides. We said, imagine there's a 300 or 400 basis point increase in yields. What impact would it have on each of the banks? And we based it on regulatory information that we had available. Second way to look at it is how much should yields move before each individual bank would break its CET1 capital requirement. So those are the kinds of analysis that we did, and that was basically just to assess, is this really an issue, which banks are most at risk, and then the Prudential Authority has that information to monitor those banks more closely. There were significant information gaps, and we had to make a couple of assumptions. Firstly, we don't exactly know from the regulatory returns how much of each bank's portfolio is marked to market or not. So we don't know the valuation gaps that already exist on their balance sheets. And subsequently to these analyses, the PI has done a survey and is now collecting that information from banks. So it is monitored. Another gap is that it's not only about the risk exposure, but it's also about how well a bank manages its risk. So you could have interest rate risk if your risk management processes are commensurate with the risk. We don't know that. We don't know to what extent banks efficiently hedge and who are the counterparties to the hedging. So those are information gaps. We had to make assumptions. But we are increasingly gathering more information on it and understanding it better. In our sensitive analysis, there were a couple of small banks more at risk. The big banks are fine. So we don't necessarily see it as a systemic issue unless something horrible happens and a couple of small banks simultaneously face these situations. But that, at the moment, is something that we are working on. And I think the main purpose was to focus the attention on where the problem may be more acute, and that is being addressed.
You have passed, you see, so VAFA does not have to mark you. But that's to say that our interest in functioning markets have to do with the fact that we are running a system that implements monetary policy based on a collateral system. If the markets are dysfunctioning, you do not know what value to attach to that collateral, and it thus renders the implementation of monetary policy almost difficult, if not impossible. So we have got a strong interest in the functioning of the markets so that the collateral can actually be adequately priced. Question about the recession, a technical recession, is an interesting one. You see, in South Africa, like many countries in the Anglo-Saxon world, a recession is generally defined as 2 consecutive quarters of economic contraction. The interesting thing is that you can have economic growth in the first quarter, a contraction in the second quarter, an expansion in the third quarter, and a contraction in the quarter that follows. It will still not qualify as a recession because the quarters were not consecutive, right? What is in no doubt is that what it means is that you are simply not growing. The US uses a different approach. The National Bureau of Economic Research has to pronounce whether the US economy is in recession or not. So it's not a statistical, just a statistical measurement like we have said. Contraction in one quarter, contraction in the second quarter, therefore you are in recession. In the US, the National Bureau of Economic Research have to pronounce on that. So it's a much more complex issue determining on the recession. You talked about the impact on the revenues of the government. If the Minister of Finance said so, trust you me, he knows better because he can see what comes into the kitty before I can see what goes into that kitty, because he will only report it after the fact. But he sees every day how much comes into the kitty. So when he says he is worried about revenue collections, you better heed his concern. The stuff that's raised about the rates, I just wanted to say the following. There are people with a little bit of gray hair, and so they've got a little bit more experience than lots. And I see a lot of young faces who do not know what it is like to live with an inflation of 21%. That's exactly where South Africa was in the 80s. And when inflation was 21%, the bank rate was higher than that. By now you get the gist. So, comes the transition to democracy. Inflation came down a little bit, to around 15, 16%. The interest rates were at about 18, 19%. Came 1998. We had a collapse of the currency, inflation surged. I don't know where were you, but the repo rate reached 25%. Came 2001. Inflation rose after the collapse of the rand, after some country in Latin America thought that it is a cool idea not to repay the money that it had borrowed. And the rand collapsed. Inflation rose. This time, not quite to 15%, to 12, 13% or so. the interest rate rose to 14, 15% to rein in inflation. It was reined in. Came 2008 with the global financial crisis. Everywhere else in the world, food prices were going up and all of that. Inflation did rise in South Africa. So closer to 10%. Interest rates did rise, but to more like 12% or so. I hope you get the gist. Because by the time we got to 2015, 2016, and there was a concern about the taper tantrum, and the currencies around the world adjusted because the US was going to tighten policy. Our currency also depreciated. Inflation rose, but nowhere close to the double digits. Interest rates did rise to cap inflation. Come 2018, 19, inflation declines to closer to the midpoint of the inflation target range. That meant that we have the policy space. Enter the coronavirus, we had the firepower to support the economy. We could cut interest rates by 375 basis points. Because inflation was contained. It did drop to slightly just below, even if temporarily, below 3%, but when it was below 3%, the repo rate was 3.5%. Wasn't it nice? So by now you get the gist. The higher the inflation, the higher the interest rates will have to be. If we want lower interest rates, we must have lower inflation. And the evidence does show us. But the evolution of policy in South Africa also shows that as we created certainty about the reaction function of the central bank to rising inflation, not only did inflation peak lower than in the previous inflation episodes, but interest rates also peaked lower than previous episodes. And many of you, in analyzing the stance now, you talk of interest rates have gone up 475 basis points. You seem to forget that the repo is actually only at 8.25%. And if you look at the most recent inflation, we are below 2% in real terms. It's only when you look forward about what we are doing with inflation declining that the policy rate will then start to move into restrictive territory. And so the narrative in the analysis is, you have hiked interest rates by 475 basis points. But you forget that we were actually coming from 3.5. And we were at 3.5 because inflation was below 3%. And as inflation rises, it is difficult to justify having interest rates that are below the inflation rate. And our interest rates during the period from 2021, as inflation was rising, our policy rate was below the inflation rate, meaning we were running negative real interest rates. And so you've got to understand this thing that you can't have negative real interest rates forever. Policy must normalize, interest rates must normalize, and failing which we will not be able to cap inflation. And our failure to cap inflation is a punishment on the working people of this country because they've got no means of protecting themselves against inflation ravaging their incomes. And that is where we come from. Thank you very much for your attendance. Hope to see you again soon. I don't know if anybody is going to tell you where to get the liquidity. There might be a decline in liquidity in the financial markets, but there is still ample liquidity in the central bank, and so do enjoy it outside.
Thanks, Governor. You ran ahead of me about the liquidity. But thank you, everyone, for attending. Thank you to our panel members. Thank you to DG Fundi, who is out of the country, but she joined us online. And the liquidity and the food is outside. And don't forget to grab a copy of the FSR on your way out.